Hey guys, Mike here. So, oh boy, another tough day today, and I swear, I don't know if it's just me, but you would have thought at one point in time it felt like we were down 4% or something on the indexes. I mean, it was just this slow death by 1,000 cuts type of day where it just kept bleeding out to the very end at 3:30, I believe it was. Started moving back up some, but yeah, it was just one of those type of days. And the dollar didn't roar anywhere. I mean, it got rejected at like 105.20, which is a major resistance. The VIX was up a little bit, but nothing to write home about. It got rejected too at a certain level. But I mean, it just felt like kind of like this right here. It was like, oh my gosh, that would be the SPY and that would be the bears saying, thank you, sir, appreciate the money because I'm gonna ride you down. And when that happened was once it broke this right here trend line, which I've been talking about for a few days. Once it broke support, and some people got that as a wedge, the same way it was in August when it broke down, they just pounced on it. And one thing to really keep in mind here, guys, is this is the hourly, and it's sitting right on that 200 moving average right there. So that is a cliff, and it's important to understand. Plus, it's sitting right there by the 0.5 Fibonacci level, which usually you get a bounce. But also, the reason why the 200 is so important is this is what happened. We sold off in August. We end up coming down. There's the 200, and once it broke through there, you can see what happened. Boom, like a waterfall effect. Okay, because we've already broke down on the 200 daily, and then we've already broke down, this support level we had, and so it's just one of those things. If it breaks, and you can see how hard this is on the hourly, it tried to come back up, and it was rejected off the 200, off the hourly chart. So if that breaks, yeah, you can bet money we're probably gonna be filling that gap right there. And so it's something to really, really keep in mind. And what's weird to me is if you look down at the volume down there. What I can't tell is I don't know if this is shorts coming in, because when you short a stock, for those who don't know, you're literally selling the stock and trying to buy it back at a cheaper price. But that's a lot of red candles, and I don't know if that's just people shorting the market, getting in their position and riding this down, or just people taking profits. Honestly, I don't know. Can't really tell the difference. Who knows? If you can, let us know, but I've never been able to tell the difference on that. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. And so tomorrow will be interesting, right? I think a lot of us expect to bounce. I know I expect to bounce when I see something like that. It usually does bounce off moving averages like that or support levels and stuff. And so it won't surprise me a bit to see that. But again, if it breaks, then you understand why the market's going to sell off. But I don't know if it's just me or what, but I really feel like the market is just trying to set us up for a Christmas rally. That's what I believe. I believe it's trying to sell us off to go into the CPI data reading next week and then see what that sparks, right? It's either going to spark a rally or spark something else, okay? And so that's what I feel like is happening at least. This ain't the first time we've been sold off going into CPI data readings, and the Fed, of course, right behind them is going to be doing a rate raise, either of 50 or 75. Everybody's thinking it's 50. But to show you some other data, and this is really crucial to watch this, is there's always a bull market somewhere, guys. And you can see right here, India's stock market, yeah, it's up for the year. And I mean, you would think India, I mean, they're one of those, emerging markets and everything like that. And you can see somebody, I don't know if it was Apple or who it was, moving their manufacturing to India, but they're actually up on the year. And this is a really interesting one right here. Bears market retail investor stocks, bonds, and cash allocation from 87 to 2022. And I think this is important because if you look, stocks on the top, cash second, bonds is third, right? And it's compared to all these crashes where they're at. Well, look at cash. It looks high, but when you look at it, if you compare it to the dot-com bubble crash and the financial crash of 08, we're right at the same levels. Look at the stocks, though. Here's where we're at stock, still 62.4% sitting in stock, right? But we draw a line. Well, let's see. That's the same part right there that they were at in that area before you had a huge drop down, and in that area before you huge drop down in 08, right? So before you got capitulation in the markets. Because that's what flushes everybody else that last little bit, right? And so is that what's going to happen? We don't know. But so I'm not really shocked. We're still sitting at 62.4% at all. When I look at that, same way with the cash, right? And so, I mean, bonds may shock you a little bit, but not really when you compare them to the 08 and 01, right? And so that's where we're at. If we do get something bad happening in the first quarter, second quarter, if that's what earnings does, and they suck, then that's what we expect. Now, this is also a ratio of S&P 500 high beta index stocks, the risky stocks, right? And the S&P 500 low volatility index. Well, this shows you we're just not taking on the risk, right? We're being very safe about it. And you can see that, that because March 2020 on up, that was the high beta stuff, right? The ARK and Best and things like that. And people just aren't taking that on. I mean, if you look at RK, it's just hovering between, what is it, like 32, 35. I mean, it's sitting in, I've sent out to the members, it's sitting in this wedge, and it just keeps getting tighter and tighter and tighter to where eventually it's going to have to make a move one way or the other, up or down, right? And it's going into the first quarter of 2023, I would say down probably if earnings sucks, and then if earnings don't suck, it's going to go up, right? Because that's why a lot of the big money piles in those high beta names, and you can get a big return fast, right? You can look at what's happening to Chinese stocks, right? That was high beta stocks, and they were, toxic, and big money started piling in there and just drove those stocks. And even today, our market's red, the Chinese stocks are green, even on a day like today. And so they're holding up because big money's in them, right? And they got in those stocks for a reason. And so, and I've showed you multiple times and the members too, that when a stock gets down to 90%, that's like this magic number. All of a sudden you see this huge run up, huge spikes in volume, right? And so, I don't know if it's the algorithms, whatever it is, pushes those stocks up. And it ain't like all of a sudden their fundamentals got better. I guess it did because they're dirt cheap now. Maybe that's what happened. But all of a sudden they start liking their earnings and everything. This is great, even in a bear market, right? While they sell off mega caps and everything else. And so I thought that was interesting. And, I always talk about 2023, and this is how hard it is to figure out what's going to happen in 2023. Here are institutions which have huge teams researching all this, right, and trying to come up with projections that don't make them look totally stupid. And look how wide the gap is, right? I mean, you got S&P 500 targets 2023. This is year end, right? Just came out. Barclays 3675 goes all the way down to 4500. Huge swath of this, right? You can read for yourself. 3900 is Morgan Stanley, UBS, and Citi. 4000 is B of A, Goldman Sachs. 4050 Credit Suisse, and it goes on and on. JP Morgan 4200, Dutch Bank 4500. I mean, that is a huge divide. In the short run, I mean, that is an enormous divide, right? Amongst, and think of what you want about the institutions. I mean, these people go to school for a reason. And you don't want to put something out there like a total idiot at the end of it, because you're trying to base your models off of stuff like this because you have many clients who give their money to you. And so you want to make them money, and so I know they're enemy number one, and I don't exactly care for them, but I know the games they play. But in this instance, if you're going to put this out there, if I was going to put a projection out there, I wouldn't want to put something false out there, because then you come back to the end of the year and go, you're an idiot. You were 500 points off or something, And so, but that's how hard it is. People just don't know. Even talking to the companies, you hear them all the time. Talking to the companies, this is what they're projecting, and it doesn't sound good for Q1, Q2, Q3, Q4. Seem like people are pretty, at this point in time, assuming inflation comes down, a lot of assumptions here, that the Fed stops raising rates, things like that, earnings will obviously get better, right? Because input costs go down. Maybe they end up getting wages under control, that kind of stuff. Maybe they're able to find enough help, whatever. And so, that's what people are looking for the second half. Just the first half, kind of rough. And that leads us into Jamie Dimon, which I don't play him very much. But when you're the CEO, like the biggest bank in the world, I believe it is, JP Morgan, then, JP Morgan Chase, excuse me, then you want to listen. But there's two quick blurbs. He talks about one, and I've been digging right and left. Sometimes I find data about how much money we actually have, like piled into the banks. And remember, it was like 2.3 trillion to start off with, like at the beginning of the year. And I kept saying through the mid-year, I said, man, this numbers had to have shrunk, right? And then I found one data point, which I was able to show you, and it has shrunk to like 2.1 trillion, I believe, from 2.3. But he just came out today and said how much we still have on the sidelines and exactly when they estimate it's going to be gone, which is something to know. And then two, talks about Fed and quantitative tightening, and he's actually wrong in his comment, and I'll show you why. If you look in the short run, the consumer is spending 10% more than last year and 40% more than pre-COVID. They're spending it in different things, so all your speakers up here, some are doing better, some are doing worse. That's a tremendous sum of money, and they have $1.5 trillion still in their checking accounts, more than pre-COVID. So the spending is down. That's the good news. And the companies are in good shape too, by the way, and their balance sheet, consumer balance sheet is in great shape. The other news, which is not good, is that rates are now, 4% on their way to 5%. Inflation is eroding everything I just said, and that $1.5 trillion will run out sometime mid-year next year. I think that you have to look at the other risk we have is quantitative tightening. We've never had it before, ever in the lifetime of mankind. So I look at that as something we should be quite concerned about. And the suppression of the 10-year bond rate has been going on for 20 years, and it can't really be suppressed anymore. And QT has just started, so it's very possible. And if you have like 2% on inflation, you should have a 4% bond today. And this is what I'm talking about him being wrong. We have tried quantitative tightening. We tried it in 2018. You can see right here we're at 4.4 trillion, went down to 3.75 trillion. And then in October, the market crashed and burned with a taper tantrum. And then you look what we're doing now, of course. Now this is on a much bigger scale. And what do we top out at? Around like 8.945 trillion. So 8,945 billion, somewhere in there. And now, of course, it looks stupid, but we ran off like 300 and what is that, 70 billion, I think, if I'm doing that in my head correctly. And I get how that sounds like a freaking joke, right? I mean, so, but the fact we've not done it, no, we tried it. Didn't work, right? Didn't work. The market went, oh my God. Okay, and you're seeing that, and like you said, you'll feel quantitative tightening faster than you will the interest rate hikes, right? And this is why this is just a big experiment. I think it was Bernanke said back in the '08 crash, I think, that when they did a QE, it was a total experiment, never been done. They didn't know, they didn't have any clue what was going to happen 5-10 years down the road. Of course, we know what happened. We went on this huge bull run, is what happened, because all the free money and everything else, and now we're paying the price for it many years later. And now trying to get it back under control, right? And so, again, that's the thing that everybody's waiting for in 2023 is we felt so many different things now, but we haven't felt this yet. Like, when are we going to be feeling this? And how is the market going to react? You know, because you got some markets like India, they seem to be doing just fine. Some emerging markets are doing fine, right? But here in America, you know, it's like the reset button. And so we're trying to get rid of that big bubble, burst it down, get back to the mean, and then go on from there. The question is, where's the mean at, right? And so that's what we got to figure out. And a lot of stocks, that's why you see those 90% down stocks popping, because they're well below the mean in most of them, right? They just got destroyed. I saw a deal where SPACs, remember the SPAC stocks and SPAC mania and all that stuff I used to talk about? And we were, oh yeah, look. And those things are just, oh, the deals are falling through right and left on those things. And so I don't know if you'll ever see them again. So yeah, I mean, that's kind of where we're at. And I was hoping, for those who stuck with me, this right here, maybe you can help me out. Put this down in the Discord for the members and stuff and try to help me. But it's something new I'm trying to figure out. And I put in here that might be a stupid question. I'm trying to learn to read these option flows that are coming across, and I can't figure out how you tell. Like, I'm talking about for the whales, right? These big, like $2.3 million option sweeps that come across, and this one came across on puts. But how are they being bought or sold, right? Because that would indicate two different things. And of course, I figured you couldn't tell, and I ended up being right. So somebody said, that's what it looks like right there if you're curious. And because options run the market, and of course, somebody came back and said, from their understanding, that they don't think you can see the way, of course, on that. But then somebody else came across and said there's this site right here where you can read the volume coming in and stuff like that, and gives you a good idea of where the money's going to. And I don't know about you, that was like something I saw in science class or something. And I believe that site's called Book Maps or something, they told me. And so there's another one called Cheddar Flow, I know, that comes in with these option sweeps. And so, you know, I'm always trying to learn something, get better at it, because options runs the market. I've showed you that in videos, right? These big, and I'm talking the big whales, not us. I mean, these big whales coming across these $7 million, you know, call options. They're either buying or selling, but if they're buying them, also that's making the market maker take the opposite and then have to buy the shares and driving these stocks up. So if you can obviously be in the know while you're trying to do your trading or investing, it might help, might not. But, you know, I'm always looking to learn something new. And so if I can find a site, you know, maybe you guys can recommend it, or one you find really well, then I would absolutely pay the membership just to put literally a channel into this Discord to track that for everybody who wants to see it. So anyway, just want to put that out there. Again, appreciate all your support and everything, and watching the videos and sharing the videos and giving them a thumbs up. I really do appreciate it. And I'll see you guys tomorrow.